Welcome to This Explainer. I want you to imagine that you and I are just sitting right across the desk from one another right now. Go ahead and sit back, take a deep breath, and let those shoulders drop. If you're joining me, chances are you've been opening your mail or checking your inbox and you're staring at a stack of incredibly confusing investment paperwork. Well, as a financial advisor speaking to a new client, I'm here to tell you that you are not alone. And no, the IRS is not waiting outside your door right now. Our goal today is to take that overwhelming pile of tax jargon and translate the whole shebang into clear, totally manageable concepts. There's a specific kind of dread that hits when you open your email in late January and see a tax form from your brokerage that you've literally never seen before. You probably have absolutely no idea what to do with it. For so many first-time investors, this is the exact moment the sheer excitement of building a successful portfolio suddenly collides with the cold reality of receiving complicated IRS paperwork. I mean, you took the leap, you bought the investments, you watched your balance grow, and then, boom, a 1099 form shows up. And right when that form shows up, the very first thing new clients ask me is, wait, did I do something wrong? I want to look you in the virtual eye right now and reassure you, absolutely not. You haven't made a mistake. Receiving this form will not automatically trigger an audit. You don't need to panic about owing money you haven't budgeted for. The only reason you're feeling this anxiety right now is simply because no one teaches the tax part of investing. Everyone loves talking about picking stocks and timing the market, but the actual mechanics of what you owe, that always gets buried in the fine print. So let's take a deep breath. Here is our clear 5-step plan for today. Number 1, welcome and don't panic. 2, the 1099 DIV dividend surprise. 3, 1099B, gains and losses. 4, the cryptocurrency tax curveball. And 5, reframing your wealth strategy. All right, diving right into section 1, welcome and don't panic. We're going to cover exactly why you are receiving these forms. Before we even look at a single number, I actually want to praise you. You successfully invested your money. Actually making money is the only reason these forms are showing up in the first place. Your brokerage is required by law to send you a 1099 for any taxable account where something reportable happened. But notice that key word, taxable. These rules only kick in for regular brokerage accounts where you're investing with money you've already paid income tax on. If all of your investing happens inside a 401k or a traditional or Roth IRA, you generally won't receive a 1099 for that activity. Those are tax-advantaged accounts. So those retirement accounts, they are safely excluded for now. We are strictly talking about your regular taxable brokerage accounts. Moving right along to section 2, the 1099 dividend surprise. Let's understand your dividend income. This brings us to the most common form you're going to see, the 1099 div. This form simply reports the dividends your investments paid out to you during the year. But here is the curveball that catches almost every new client I work with completely off guard. That income is taxable the year it's received, even if it is automatically reinvested. A lot of folks are super surprised by this. They set up a dividend reinvestment plan, they never actually touch the cash, and then they discover they still owe taxes on it. So I need you to remember this rule. The IRS considers a dividend to be income the very moment it hits your account, whether you touched it or whether you used it to buy more stock. The reinvestment part doesn't change the tax treatment at all. But hey, there's actually some really fantastic news to balance that out. On your 1099 DIV, you're going to see 2 categories of dividends. Ordinary dividends are taxed at your regular income tax rate, the exact same rate that's applied to your salary. Qualified dividends, however, are taxed at the much lower long-term capital gains rate. And the absolutely crucial point here is this. Most dividends from large American companies held in a standard brokerage account actually qualify for that lower rate. It saves you money. And the best part, you don't even have to do the math. The form is going to show you exactly how much falls into each bucket. Next up is section 3, 1099B, gains and losses. This covered the mechanics of selling your investments. So if the 1099 DIV was all about what your investments paid you, this next major piece of paperwork tracks what happened when you actually decided to sell a stock or a fund. Now, whenever we talk about selling, we run headfirst into a piece of financial jargon that sounds incredibly intimidating. Cost basis. Let's just demystify that right now. Cost basis is simply what you paid for the investment originally. That's it. It is just the starting line. The difference between this starting line and what you eventually sold the investment for is either your capital gain, if you made money, or your capital loss, if you lost money. And this right here, this brilliantly illustrates why, in investing, patience literally pays off. Your holding period is critical. If you hold an investment for 1 year or less, it's considered a short-term gain, and it's taxed at your ordinary income rate, say 22 or 24%. But if you hold it for more than 1 year, it becomes a long-term gain. That means it's taxed at the preferential capital gains rate, which is typically just 15% for middle-income earners. Just holding an investment a little bit longer to cross that one-year threshold drops your tax burden significantly. Okay, but what if you lost money? I actually love sharing the silver lining of capital losses with my clients. If you sold investments at a loss, those losses offset your gains dollar for dollar. But what if your losses are actually bigger than your gains? Well, if your investment losses exceed your gains, you can enthusiastically deduct up to exactly $3,000 of that excess against your ordinary taxable income for the year. It literally lowers your regular income taxes, and any remaining losses just carry forward to future tax years. That brings us to Section 4, the cryptocurrency tax curveball. Here is why the IRS is paying very close attention. We really need to pivot to a modern investment trap that trips up a lot of smart beginners, because the rules here are a bit different. If you own any crypto, I need you to make this crucial mental shift right now. The IRS treats cryptocurrency as property, not as currency. This classification completely changes the tax implications. You aren't just exchanging digital dollars here, you are trading property. And because it's property, we have to walk through the specific taxable events. Selling crypto for cash? Taxable. Trading one coin for another, say swapping your Bitcoin for Ethereum? Taxable. Using crypto to buy goods or services? Yep, taxable. If you made dozens of small trades, every single one needs to be accounted for. Now, while most exchanges provide forms these days, the ultimate responsibility to report this sits squarely with you. Avoiding this common reporting mistake will keep you safely off the IRS radar, especially since this is an area they are specifically focusing on right now. Let's wrap it all up with Section 5, reframing your wealth strategy. We're going to talk about taking control of your tax return. So we're going to shift from a mechanical review of the forms into a powerful strategy session on how to handle the actual filing. When you finally sit down to file, I want to reassure you that the process is actually very easy. You don't need to do difficult math. Step 1. Tax software like TurboTax or H&R Block will allow you to import your 1099 directly from your brokerage. Honestly, you're mostly just confirming data at that point. Step 2. Double-check that your cost basis and your short and long-term gains are categorized correctly. And Step 3. Verify that your losses have been applied to lower your tax burden. Remember, you're in control of confirming the data, not calculating it from scratch. Now, understanding these steps leads us to one of the most counterintuitive phenomena in investing. You might actually owe taxes on your investment account even in a year when your portfolio lost value overall. Sounds crazy, right? Why does that happen? Because the overall account balance at year-end does not determine your tax bill. Specific transactions do. Say you sold a position at a gain in February, and then the rest of the market crashed in October. Well, that February gain is still taxable. This is completely normal, but it proves exactly why we must be absolutely deliberate about when we sell. Which brings us to my final thought for you today. Your return isn't just what the market gives you, it's what you deliberately manage to keep. Understanding your 1099s isn't some boring chore, it's literally the ultimate scorecard for your wealth-building strategy. It's the clearest window you have into whether your strategy is working as efficiently as possible. So take that deep breath, use this structure, and go take control of your filing. But ask yourself this before you do. Now that you know how the IRS scores the game, what are you going to do differently in your portfolio on Monday morning?